Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about housing credit, housing stress, and mortgage rates. As always, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah. And I know we're all kind of a little bit stressed because Thanksgiving dinner this time around might be a little bit hectic, but I've got a solution for everyone. We just got the updated Federal Reserve, New York Fed housing credit data. And since everyone has an Uncle Dave in their family, or an Aunt Melody, or an Uncle Vlad, or a sister-in-law Danielle, or somebody like that, we have all the charts updated, and we wrote this on Friday for everybody, and you could just show those charts out and tell everybody, hey, it's not housing 2008, guys. It's like, it's the last 14 years. Like, what are you guys doing? Literally, we have certain men, you know who you are, who have literally spent a decade trying to push this. And like I said, it doesn't get prettier for them. They're not the chart daddy. You know, aging for some guys is hard. And now at the end of 2024, this was it. This was supposed to be my last year. The whole credit model thing that I talked about in the last decade, which I highlighted a little bit in the article, held this entire 5 years. This is why I said I never flinched, because I knew what the underlying credit standards were. So what everyone was thinking was going to happen is something that, like I've always said, American homeowners don't act like middle-aged men podcast stock traders. Podcast stock traders would sell their house in a second. They have no relationship with their family or kids or whatever. They're all over the place. You know, I'm going to sell my home and buy Bitcoin. And no, normal human beings do not do that. They live in their homes. We made a joke about this on Friday morning. I said, how did everybody who kept on telling me they sold their house and waiting for home prices to crash to buy up again? Every year I get guys who do this. And I was like, you didn't do it. So give me your address. Let me see. You know, and it's this theory that, we're going to go and we're going to sell the house, and the kids and I, we're all going to go move and rent in the other city because it's cheaper. And then when the 200-day moving average of the Case-Shiller index comes down, then we're going to come back and buy a house again. If normal men, acted that way, the divorce rate would be up 38%. But that's not true. Normal men don't do this. Podcast stock traders will in a second. And this is why the new listings data, which was stable from 2013 to 2019. And I know people know who I'm talking about. The people that said, we were going to rush, people are going to rush to sell their homes. They're rushing to sell their homes. New listings data in 2023 was the lowest level ever. New listings data in 2024 is the second lowest level. We do not under any circumstance listen to podcast stock traders about housing economics.
No, that's why I have you on. Okay, well, let's dig into some of the internals of like where we are with credit. So one of the things that people have been worried about is looking at the credit card balances, the debt that people are carrying. And so it's like,
how has that worked out for anybody the last 14 years? How is the credit card balance thing, which happens every year because credit card balance grows every year people, oh my God, credit card balance is here. Credit card balance is here. Credit card balance is here. Here we are. It's 2024. 2022, 2023, and 2024 credit card balances. People are going to, oh my God, it's the second lowest new listings data. We have models. And what occurred, and this is one of the reasons why I think 99.9% of the people you listen to in housing have no actual working models. What occurred back then is our new listings data took off and stayed that way for like years. And a really good example was like recently we had a new listings, which I highlighted in the article. It's 48,000 new listings. Extreme low levels for this period of time. It was running at 370, 350, 296 in a seasonal down period because it was running at 250 to 40,000 to 400,000 per week for years. Here it's like 30. Yeah, per week. It's like 30 to 90K. So I am glad you all can look at the credit card debt data, and it does not mean what you think it means for housing. And when you look at the stress in the data, single household renters, it's like, oh my God, that 26-year-old has bad FICO score, his credit card deal, he's going to sell, he doesn't own a home. You guys have to learn to connect the dots on housing. And that's why we're here. I know y'all can't do it. I can do it. We do it every single week. When our data goes negative, this is why the tracker is think about it. On planet Earth, whoever's not reading the tracker is just simply behind the curve, right? We'll let you know because we've back tested this and we've seen what happened in 2008. We saw what happened in stress data. We'll be the first people to do this, but it isn't this year, right? It wasn't last year. It wasn't the last 13 years. And this is why we've collected a collage of 13 years of reasons that were supposed to be the big housing price crash. It never happened. So when I die, Sarah Wheeler, they're going to say that homie with his name and face took on an entire crazy clan of doomers. And they will say, oh, they all failed. Some of them are brave enough to show their names and faces. But now all of you, Auntie Melody, sister-in-law Danielle, Uncle Dave, Uncle Vlad, you all got enough charts to show it to them. Go, no. And then walk them to their bed because they need a nap, even before they had the turkey.
Yeah, well, I think the conversations at your Thanksgiving table might be different than mine because we don't really bring out charts. But I do appreciate the idea there.
But if you had an Uncle Dave, now you can.
I did. No, that's true. That's true.
Yes.
Okay, well, let's talk about so new listings data obviously would be a sign of stress. Let's talk about foreclosure data. Let's talk about FICO scores. What do you see in this report?
So number one, FICO score data. Unbelievably great, has been great for 14 years. And what the conversation has led recently is that there are people who said, oh, FICO score inflation, they're challenging it wrong. I was like, dude, just look at the last 14 years. I mean, even Mark Calabrio didn't even know this. Look at the last 14 years. It has literally been the same trend data. And a lot of people see the volume rising and they think the score is being artificial. No, we just did more loans. And then the loans came down. They all look the same. And this is why I incorporated this as the sexiest economic data we have out there. I mean, literally, Sarah Wheeler, I am putting that jazz music on. I am putting that cognac on. It is 8:00 at night. And I just sit there and look at that FICO. Oh, she is gorgeous. And the world hates us for it. And the doomers hate us for it because most people have 30-year fixes, fixed debt costs, rising wages. They had good credit going into the transaction, and over time things get better. So it's not shocking we're sitting here, but we're like, oh my God, oh, that person's credit card debt.
Okay, delinquencies, where are we with that?
Now, this is where I got this wrong. I had anticipated us to get to pre-COVID levels before 2024 on the 30, 60, 90 days. Now remember, 1% to 4% of all housing loans are in some kind of distress, always. That's always the case. We don't have zero. It's like we don't have zero jobless claims. The people get fired every single week. People lose their jobs financially, but it stays within a very low base. This data line did not get back to the levels I thought it would by the end of 2024. So the data is even better than I even thought. And again, that goes into the whole, one of the things we always do, crayon economics. Why do we do crayon economics, Sarah Wheeler?
Just to make it easy.
It's just to make it easy. And if a child, you got these guys who say, I went to so-and-so college. And I'm like, oh my God, your 5-year-old knows better than you. And he didn't go to Wharton. Okay, so in this context, we show those crayon lines, 2005, 6, 7, and 8. Foreclosures, bankruptcies were rising. Then the job loss recession was happening. Credit card delinquencies, bankruptcies, foreclosures, everything was elevated. That's the stressed marketplace. But back then, all those new listings were running into an underwater marketplace. 23% plus of homes were underwater in 2010. Now we look at it, 1.7%, the lowest levels ever recorded in history. I'm going to repeat this, Sarah Wheeler, 1.7%, the lowest levels ever recorded in history. And you're all telling me 2008? The loan to values of all the loans in America, the average balance LTVs are under 50%. Do you know what it was in 2008, Sarah Wheeler? It was near 85%.
So
Stop
the 1.
dancing with a ghost, people.
The 1.7 was the homes that are underwater right now?
Yes. And I would argue that 125 base that we see in the data lines, a lot of those are back taxes. I mean, there's just a little percentage that is over 125, which confuses everyone. There, who has 125? That's been there for years. It's been slowly moving down. So realistically, we're like under 600,000 homes that are technically underwater. But that's not counting the over 40% of homes that don't have a mortgage. So the LTVs are not 2008. Their credit data is not 2008. The foreclosure data is on 2008. The loans aren't 2008. Stop dancing with the ghost. And the reason we say this is because one of the things that I should have done earlier in my career is show the history of home prices going back to 1942. And then you could all look at that and say, oh my God, really? There's only one period of time in history after 80 years that home prices crashed, and that was 2007 to 11. The models will guide you to credit stress data. It's just not there. So hopefully, I think most people understand this, but we always, every single year, because at some point in the future, jobless claims will rise, credit delinquencies will happen. We can make a case that in Florida, there are people stressed, sellers that are stressed, that don't want to live there anymore because they can't get insurance. There are parts of the country where we could map this out. But in the general economy, the history of bubbles, you don't have them in the same sector back to back, because what created it usually is not there the second time around, right? The next cycle. This is what this was. This was the historical context paper that you could see that this was here for this reason. This never happened. And now it's the end of 2024.
The end of 2024. We still have not seen a crash. I'm glad you brought up Florida, because there are parts of the country that are seeing that stress. Where else? Is it just Florida? Is it also Austin?
My thing with it is that the reason I like to separate Texas and Florida is that Texas has an affordability issue and a lack of migration. So in this context, the inventory there is rising, but also Texas and Florida they don't have state income taxes. So they make a lot of their, revenues, property taxes as well. So property taxes, insurance are up, but I wouldn't say Texas has the stressed insurance issues in parts of Florida. That's why I like to separate those out there. It's just inventory is growing. And in that context, you don't see like, I can't afford insurance. I can't get insurance. If I can't get insurance, I can't have a mortgage. Two different marketplaces, but one thing is common. Both are revolving off of this one theory. First, prices escalate out of control, then rates. Those two things are the same variables across the country. But here, these two states, which over 40% of the inventory growth in 2024 were from these two states, property taxes are up, insurance are up. Some people can't get insurance. There are different things that are happening in Florida that's different than in Texas. That's why I like to separate those two. But both need some kind of migration data or migration growth to keep it alive. Texas needs the California money. Florida needs the migration from the Northeast. So that is demand. If that demand is drying up, then you're leaving it to the local community for the home buyers in there. So naturally, inventory in those places can grow. And it's not just Austin, San Antonio. There's other places in Texas that are like that. Because I look at San Antonio and I'll go, oh my God, it's so cheap. I look at San. I was like, oh my God, these single family homes are like half the price of condos here in Irvine, California. You should never use Irvine, California for anything. But if you don't have people coming in there with that kind of the bigger money, then you fall back into your local economy. And obviously, with rates this high and prices this high, demand gets hit. Simple economics there. Not stress, but affordability, I would say, in Texas.
Could you not see some of the same things happen even if it's not stressed, but it's affordability? So you have way more homes on the market.
We have never seen a national housing price crash based on affordability. And that's why we always talk about the early 1980s. Now, the early 1980s had worse affordability, but what occurred was that eventually there was a recession, mortgage rates did fall, and housing demand picked up. So if you wanted to do a counter theory to my 1980s model, is that the economy isn't going into a recession. Mortgage rates don't fall ever, and they stay elevated. And then it would be a kind of an ebbs and flows of pricing, but not a crash. Like we've had periods of times where demand is weak and rates are elevated, but you don't see, the early 1990s was the 1 year. If you take 2007 and 11 out of the equation, we only had 1 year post World War II where home prices fell. That was 1990. And 1990 had stress in Southern California. You could make a case elevated rates. Like I have 17 different ways I could have home prices fall in 2025. You just model things out. But here's a quick one. Let's say mortgage rates are 7.75 to 8.75, never goes down. Inventory grows. Florida gets the stress. That marketplace gets a little bit more decline than the others. There's flat pricing. There you go. You get national prices falling down a little bit. That could be the case. But if you're talking about crashes in prices, like the educated class of our society, I'm going to sell you my house at 40% off. Sir, your home is technically underwater if you try to do that. Oh, you mean the bank won't let me? Yes. Housing isn't a very liquid marketplace. That's kind of why. And plus, again, when you sell your house, you're a primary resident person, you have to find somewhere else to live.
So when you have that rising inventory, when you have affordability issues, then you see prices start to come down. So I do think Austin is like center for that, right? Like I feel like of the whole country.
Austin is a really good example. I think we talked about that in that one podcast. Austin home prices went up 76.5% in 2.5 years.
That is crazy.
Okay. Imagine if America home prices went up 76.5%. And then all of a sudden, like Austin needs California money.
Right.
Imagine if America home prices went up 76.5% in 2.5 years, which is crazy. But if it did, and we needed the Canadians and the Mexicans and the Chinese and everyone coming in to buy homes in America because they're a big, well, Austin, elevated prices, elevated rates, lack of people moving. Yeah, I mean, home prices aren't crashing like they were that first year, but you can see what happened there. You had a very, very high elevated price, and then it kind of came down. There's no migration. Rates are too high. Yeah, you get that. On a national basis, not the case, right? Again, I'm most likely going to be wrong in my 2024 price forecast. I'm going to be too low. But hopefully by now that it's, 5 years, and now HousingWire, through this most chaotic time in history, you all know the chart daddy's here to play, right? When the data gets weaker, we will let you know, and we can zip code anything out. Why do you think people love Altos Research?
And just for our listeners, we are working on a feature on Austin home prices, since it is quite interesting what's happening there. Just because I know, I mean, if you're around that area, it can feel pretty bad.
Oh yeah, and again, there's parts of the country that have an elevated growth of prices, and those are more at risks, especially places that need migration. Right?
Yep.
If people aren't moving there, the demand's out there. We had that podcast, I think, a year ago or earlier in the year, where we talked about the economics of places that need migration from wealthier home buyers. If that's not going, boy, tough. Tough.
Okay. What are you looking forward to on the tracker this weekend?
Well, the tracker last weekend was a little bit funky. It wasn't shocking to me that inventory fell or pending home sales fell because rates are elevated. Remember, model 30 to 90 days out on mortgage rates to purchase application data. But the new listings data fell way more aggressive than I thought. So I mean, I'm not a big election guy person, but just for this 1 week, maybe we had a little bit more people that held back on listing their house or doing any kind of housing activity until that. Generally speaking, the run up to the election, when mortgage rates fell, demand picked up. And then when mortgage rates rose, demand faded up. So there's nothing abnormal about it. But just this 1 week, I'm hoping we see inventory come back a little bit, new listings come back a little bit, and just try to maybe balance out that 1 week data. But I think the week itself was really interesting, with Powell and some of the Fed presidents on talking about mortgage rates and policy going out. And as we're talking right now, the 10-year yield is at 4.43%. It's just this tug of war right here. We are just literally battling out at this key level. And for the Instagram family, we got like 500,000 people now come there a month now. We do these things on stories where we try to like talk about it and show the charts. And I was like, oh my God, I'm going to educate people on 10-year yield channels. I love it, and then, it's been very, and this is a week that retail sales came out on Friday, not only beat estimates, they revised the other months higher, which were already beating estimates out there. So we always said it, the economic data gets better, 10-year yields, but there's key levels Jerome Powell talked about, wow, here, this is where Jerome Powell, I think, made a big mistake. He's like, the economy's strong. We might not need to cut rates faster. And then it's like, you just cut rates 0.5% back then. And now you're okay. This is why, what do we say, Sarah? If you use the word strong, you're opening yourself up to like your ideological takes or everyone's ideological takes. And boy, if they don't cut rates in December, Trump's going to go after Powell, just like, and it's interesting because today the 10-year yield kind of went up a few basis points and then gave it all back and went lower. But the retail sales were good. Industrial productions beat lowered expectations. But we've had Fed presidents start to talk about more about the 10-year yield. President Logan from the Dallas Fed, who I would consider a hawk, kind of said, listen, if long-term yields are going up, we don't need to be as restrictive because that's financial conditions are tighter in a sector that has already seen weakness for a long period of time. Austin Goolsbee, who's not a voting member, he's like flat out, why is the 10-year yield going up? We got to get rates lower, So it'd be hilarious if Trump elects him to be, because, obviously he wants the lower rate camp. But there's no Fed Treasury pick yet. Everyone's wondering what's going on. I think Powell, I think Trump wants a person to guarantee him low rates. And what Mnuchin said, we want a cap. We don't want the 10-year yield going over 450 ever. And I'm wondering if part of this, because he talked about Larry Kudlow being the Treasury. And it is interesting because in 2019 and 18, one of the fun things I've had during that year is that a lot of these people before Trump became president are, rates are too low. You got to get rates higher or inflation and everything. And then all of a sudden when Trump was president, they're like, oh my God, rates are too high. Inflation is like, I had a lot of fun with it, and I could see this. I could see how some of my counterparts who are housing price crash people are usually conservative. Some of them are just like,
they don't want to say anything right now.
They don't want to say anything because, they want Trump to do good. And all of a sudden they can't go out there on their Twitter accounts and do. Now, not all of them do it. The real true believers don't care who the president is. They're going to go after them. God bless their souls. They are true believers. I always respect the true believers. But some of them have just like, so it is what it is. I don't care about political ideological theory or anything. I don't care who the president is. I'm just going to look at the data, good or bad, whatever it is. We go with cycles. And it's just, in this day and age, so much information is given on ideological takes or doom porn takes that you don't get the real story. But we are legit down the middle line. Go for it out there. And you can see it with our work and how we perceive things.
That's always the goal. Okay. So let's talk about mortgage rates from a very, not that, high level, what they're talking about, but where do you think we're going to be? It's got to be one of the most disappointing things for anybody in mortgage or in housing this year. The fact that rates have stayed as high as they have, they got a little bit lower before, and then now they've been up. And just when you think about,
why did they go up higher? Because we had a series of economic data, which nobody wants to talk about.
I know.
The retail sales, but it is interesting that this week with Powell, the CPI, PPI inflation, retail sales, all this stuff, if the 10-year yield was at 383 with this week's data and verbiage, boy, that 10-year yield's shooting up higher. We're kind of putting a big fight right about here. And as the Fed keeps on lowering rates, it becomes a little bit more difficult to, have a good valid reason to shoot the 10-year yield higher, especially when Fed presidents are talking about it right now.
But here's my question. Here's my question. So now that Fed Powell's been like, maybe we don't have to lower rates again. Do you feel like it's already been priced in whatever he does, or are we getting to the point where things have not been priced in? It would actually make a difference.
The Fed funds rate is kind of irrelevant to me at this point because I think a lot of easing has already been priced in. I think real traders have already kind of thought they're going to go to neutral depending on how fast they do it is really the economic data. It's really the economic data at this point. And I think this is the thing. So many people were promised lower mortgage rates for the last 2 years. And there's just some people who should not be talking about mortgage rates ever because they don't track this stuff. And then there's some people who are just keep on saying the economy is so weak that we're going into recession and this hasn't worked out for year 3. And here we are today. And that's why I always show that one time when we did that podcast, the economic surprise index was beating retail sales, just like had a big beat in positive revisions. If this wasn't happening, the 10-year yield's lower. Right. So I just work off the economic data to kind of where the 10-year yield range is. And again, for 2024, it was like 7.25 to 5.75. For majority of the time, that was the case. I don't believe in what we call mortgage rate targeting, where we give someone a rate and then like a month later or 3 months later, hi, how are you guys doing? Here's a rate. We want to teach people this. So then all of a sudden, everyone else starts to, hey, I got to look at this data. I got to check this. Oh, this is a key level. All these things.
So my question is, so from your perspective, if you're out there, if it's your dad, if it's an originator out there, they shouldn't really think like whatever happens with the Fed in December is not going to matter. Or if you're the bond market and you see that the Fed didn't cut rates, does that tell you, it's going to go higher?
Fed didn't cut rates in December. The economic data warranted it. That's why we track the economic data. The Fed only meets every 6 to 8 weeks, but the economic there is daily, weekly. So we fall off of that where Fed expectation is. I mean, it's not shocking that there's a big fight in the sand right now for this level because, for a bond fund or everybody to start selling and go up higher, it's a tug of war. It's just like the Gandalf line and the Hodor line. This is why we do ranges. We've done ranges all the time. I mean, in the last decade. My ranges and forecast predictions were correct because they stayed within a channel. The trick is finding the channel and getting it to work. And that's why 2025 is going to be more interesting because we're already in the Fed rate cut. And we're going to have a president that's going to actively try to pursue to get the rates down lower. And it's not going to be shy about it either.
Yeah, I mean, I wish it was just better news going into December, shouting out the year that we could see. But I think this is the thing that's happened all year is like what's good for the overall economy. When things are growing, when I'll use the word it gets stronger in different areas. It's not good for mortgage rates.
Neil Kashkari, our favorite person, said. Basically, I'm going to make it a very short version. We don't care about housing because we can't do anything.
Right.
That's not necessarily true, but he talked about a clearance rate. And the reason my rates range might be higher than others is that I'm just looking at their policy. But we've always said this, the Fed doesn't care about the existing home sales market. It doesn't impact their dual mandate. The new home sales market, housing starts and construction, yes. And this is why we've highlighted when this starts to fade, then everything, if residential construction workers start to lose their jobs and claims rise, then everyone could be a little bit more optimistic about rates falling and staying lower. Right. But I don't want to be that person that says rates are going to go to 5%. Yay, I'll say something that you want to hear and then not back it up with the data or just kind of presume, oh, the economy's so weak and, it hasn't worked. It hasn't worked for like the last 3 years.
Logan, thanks for being on. We will talk to you again soon. And everyone, by the time this comes out, you can also read the tracker. Thanks, Logan.
Bye, everyone.